Folks, I just don't know if my heart can take this market right now, folks. It's hurting out here. Okay, it's hurting for me. Shopify here down 17% today after reporting earnings this morning. Ladies and gentlemen, I'm getting shellacked out here, folks. If you don't know, obviously, Shopify shareholder here, getting shellacked. And that's something we have to face, is today's market. We must survive this way. But that being said, let us see what's going on with this stock. Why are these earnings leading to this? You look year to date, the stock is down 70%. I mean, this is terrible. Down 64% in the last year, but still up 370% in the last 5 years. We must preface this. But from their high points, I mean, we're talking from the highs of the highs, this stock is down over 76%. That's a shellacking, folks. That's a shellacking. If you bought in at those levels, which some people did, not me, thankfully. I did buy in around $600, though. I mean, we're talking right these levels. Ugh. But look. Let's look at these earnings first. Let's just see what's going on. That's what we got to see. Okay, non-GAAP EPS line of 20 cents misses by 45 cents. I'm not going to make a statement on a non-GAAP line. I like to look at the GAAP EPS first. I like to look at the net income. I'm not going to make a statement on that because I don't know for sure what that means for me. But the revenue came in at $1.2 billion, misses by $40 million, which is flat, all things considered. Revenue up 21% year over year. Okay. Look, we're talking about a nice growth of revenue here. It's still nice. 20+% revenue growth is beautiful. A lot of these e-commerce companies are struggling at this point. Monthly recurring revenue came out at 17% year-over-year growth to $105 million. That's fantastic. And subscription solutions revenue up 8% to $344. Now, this is great because this is recurring revenue. Both of these. That is what makes them the cashish. And this is cashish they don't have to work for, right? I mean, this is recurring revenue, folks. This is darn beautiful. Gross merchandise volume was $43.2 billion, representing a 2-year compound annualized growth rate of 57% and an increase of $5.9 billion, or 16% over the first quarter. That is nice. Gross merchandising volume increased massively here, especially on a 2-year stack. Beautiful. Gross payments volume was $22 billion, accounting for 51% of the gross merchandising volume processed in quarter one versus $17.3 billion, or 46% of the first quarter of 2021. I mean, massive growth there. I mean, what do you want me to say there? That's very nice. For guidance, this is what they show here. That's that the revenue will be lower in the first half and highest in the fourth quarter of 2022. Does that need to be in there? I mean, does this line need to be in here? This might be the dumbest thing I've heard in my life. This is just how it works. This is how retail works, folks. The fourth quarter is always the biggest. People always spend more in the fourth quarter. And it grows from Q1 all the way to Q4. This is not... what is this? What is this line doing in here? This is the dumbest thing I've ever heard. Anyways, we're looking at this greatness. Here's one part you got to listen. They're planning to acquire Deliver fulfillment technology platform here. Obviously they do it to seek fast and easier fulfillment from independent brands across the channels. Okay, that's fun. That's fun for you. That's a delivery, and I don't think people are happy about it because the stock's falling like a it's a falling knife right now, and here they are spending more money on acquiring company. I think it's a great time to do it. I mean, in my opinion, I think it's great. Thank you for reporting in U.S. dollars. You are a Canadian, company, and that makes me not want to buy you, but that's okay. You can be Canadian and fully yourself all you want, but that's all it is. So let's look at some of the highlights, folks. This is what we're going to do. Total revenue's up 22%. Obviously, we saw that. 2-year compound growth rate of 60%. So the first quarter of 2021 marked the highest revenue growth in the company's history as a publicly traded company, driven by stimulus and lockdowns. I get that for sure. But that was just highest revenue growth. They're still growing 22%, even beyond that, while other companies right now are giving excuses, right? We just made a video about Etsy giving an excuse saying that it's just difficult right now. But Shopify here still grew 22% despite the same quarter. It's the same timing of the quarter, yet Shopify grew 22%, and they're making a lot more money than Etsy. So they give a little bit of excuse here, but I think the results are still good. I really do. Because you're not seeing this kind of increase from other companies. Even Amazon, again, it's hard to grow percentage-wise for Amazon, but you didn't really see that growth for Amazon. So keep that in consideration. Shopify merchants are emerging from the last 2 years stronger and better prepared for commerce everywhere. Again, I don't know what that line has to do with anything. I don't care. I don't care about that line. But here's a line I do care about: monthly recurring revenue. Again, we like that. Every month, $105 million coming right to them, increased 17% year over year, up from $89.9 million of last quarter. That is a beautiful number. That's a beautiful number because this is where the revenue is coming from, right? This is where the revenue is coming from. More merchants joining the platform, and the number of retail locations using the POS Pro increased as well. Shopify Plus contributed $31 million, or 30%, to the monthly recurring revenue compared to 26% of last year's quarter as well, as merchants seek a greater value from their digital platforms. They're increasing their subscription plan to the Plus program. That is beautiful, and that is how, without growing users, they can still grow revenue. So, but again, they are growing users. I mean, that's just a thing they're doing. But more merchants are joining the platform consistently. So, subscription solutions revenue was $344.8 million, increased 8% year over year. Still good growth on that aspect due to more merchants joining the platform, reflecting our change in terms to make selling in the app and theme stores free for partners for the first $1 million annually. That's significant, folks. That gets a lot of new people on the platform, and by the time they hit that $1 million, and again, this is something that will hurt their bottom line. I just want to throw that one out there. Obviously, they're not collecting fees on these people for the first $1 million. That is something that hurts the bottom line, but it grows users. So it's a kind of a coin toss of what that's worth, and in my opinion, I think it's worth it. I think it's for a long-term growth standpoint, it's worth it. Obviously, these terms were not in place in the first quarter of 2021, again, and that's where you're going to see an impact on that bottom line. So I'm expecting that, and as long as you go in expecting it, it can't hurt you, right? Is that how that phrase goes? If you expect disappointment, you'll never be disappointed. Gross merchandise volume, as we saw here, came in at $43.2 billion. Beautiful. 2-year compound of 57%. That's significant. That is very significant. And what they say is that payment volume benefited from the quarter from strong performance by merchants on Shopify Payments, growing adoption of new merchants, and merchants on Shopify Plus, Shop Pay, and Shopify Market penetration gains. That's what I'm talking about. Merchandise solutions revenue, our merchant solutions revenue was $58 million, up 29% year over year. Due to the growth in general merchandising volume, as you saw, massive growth here. I mean, massive growth. What can I say there? Solid uptake of merchant solutions such as Shopify Payments, Shopify Capital, Shopify Markets. I get that. Okay, I get that. Gross profit dollars did increase 14%, which is nice. I like to see that. Well, I mean, it is nice to see that, even given the change in the terms. And again, here's where they say lower margins in the Shopify Payments was due to a mix and increase in investment in the cloud infrastructure and the impact of the change in the terms for new merchants, which I get. I really do get that. Net loss for the first quarter was $1.5 billion. Now, that one's horrific, folks. This is a line that I find horrific compared to $1.3 billion of the first quarter of 2021. Q1 of 2022 includes a net loss of $1.6 billion on equity and other investments. Okay, folks, look. I'm not upset. I'm not upset anymore. That's why you got to read a little further. So, all things considered, equity investments lost $1.6 billion. $1.5 billion here lost. So technically, this is a winning quarter. Okay, you take out this one-time net loss here line of $1.6 billion. This is a $100 million net income quarter, and that's kind of shocking. All things considered, I expected a worse line year over year. When you consider the fact that they completely aren't taking fees from these new merchants up to the first $1 million, they're not taking the fees. And this obviously was probably an investment, I don't know, in probably Rivian or something. It's all these companies are facing it. You saw Ford, Amazon lose billions of dollars off of these investments given the market right now on equity and other investments. I mean, it's just what's happening right now. So that's not too crazy. I actually really like this. Personally, again, I like profitable companies, and this technically is a profitable company. You know what I mean? But this is not a line I dislike. I really don't. It was $1.3 billion last year, and again, that didn't include a net loss because of equity investments. So, yeah, that's what I'll say. First quarter business highlights, nothing really crazy here. Merchants in the U.S. and Canada and UK received $346 million in merchant cash advances from loans from Shopify Capital. And again, these loans are to get people started and stay on the platform, obviously, because they have to repay the loans potentially. According to the U.S. government, you don't have to repay loans, though. We'll just pay you back. Because why not? Yeah, I hate people. But yeah, I mean, that's exciting stuff. What else do I need to say there? Shopify announced it became the first Canadian company to sign a power purchase agreement equivalent to powering 100% of its office buildings and employee home offices with wind energy. That's impressive, actually. Now, the only thing is, the terrible impact that windmills actually have, not only on the environment for cutting down trees, the deforestation they have to do to actually put up these windmills, as well as the numerous birds that they kill on a daily basis, and the fact that they're ugly as sin. But yeah, anyways, you can grandstand all you want, folks, but these things aren't as good as when you look at the surface. They're not as good as what they try to tell you they are. Let's just be clear with each other. Nothing crazy. Subsequent to the first quarter, they're just talking about nonsense, global impact. But they did announce, obviously, a 10-for-1 split, as well as updates to a governance structure, which will be voted on to shareholders as of June. And let me tell you, given what the stock's doing right now, people are going to vote, and I know I will. I'm going to vote the heck out of yes for this stock split, because it's the best thing that'll get this company back on track. When you're talking about a $40 stock, people are going to buy the frick out of Shopify for $40. They want this split, folks. They really do. And here they talk about the Deliver platform, what it's able to do for them. Obviously, those give a general of what Deliver is going to sell to anyone, but it's going to improve inventory receiving and inspection and cross-dock capabilities, inventory placement algorithms that route inventory based on predicted merchant demand, preparation, storage, and freight services, real-time fulfillment optimization across online brick-and-mortar, B2B, and wholesale channels, and an asset-light network of warehouse carrier and last-mile partners offering elastic warehouse capacity to thousands of merchants, which is nice for the fact that they're going to get merchandise out quicker, folks. That's what it's all about in today's network. You need to deliver same day now anymore to get people excited. That's a little bit on deliver. The transaction terms. Shopify will require delivered outstanding securities, which is approximately $2.1 billion, which is 80% cash and 20% Shopify Class A subordinate voting shares, which is good too. That's a lot of shares that they're technically buying back in that aspect too. So for outlook, they don't really give an outlook. I don't know. They aren't giving outlook because they're not sure. But for 2022, they're expecting year-over-year revenue growth to be lower in the first half. As we expected. I mean, yeah. There's nothing really significant on here. They don't really give you actual significant, substantial numbers. Let's look at the press release and be done with this thing. Okay, that's what we're going to do. Here's the consolidated balance sheet, folks. That's what I'm talking about. Other current assets, that's right. Total, oh gosh. Oh, that's a nice stretch, folks. Total current assets sitting at $8 billion compared to $8.5 billion of just 3 months ago. You see a decline here in the overall marketable securities line, and again, that's because of the equity investments line that we talked about prior. Long-term assets at 11.8 versus 13.3. Big decline there too. And again, you see this at equity and other investments, folks. That's the line we're taking a hit on. $1 billion here. That's wild stuff. And obviously the $500 million you saw was from the short-term standpoint. That is what we call rough. I blame Rivian, I really do. Total current liabilities at 681 compared to 702. That did find a decrease, which I like to see. And total liabilities in general decreased as well, 1.3 compared to 1.5. Shareholder equity did see a decline, but that's because of that equity investment thing. But this is a beautiful balance sheet. We're talking about an $11.8 billion balance sheet. $9.7 billion of that is in equity. That is a primo balance sheet. Primo, okay? That's a very quality balance sheet. What else do you want me to say? 80% of this balance sheet is equity. It's ridiculous how much profit this thing can actually churn out when you get rid of this equity investment thing. So look at the stock. We're going to refresh, see if that updates those numbers a little bit. We're talking about this P ratio line is going to get impacted, folks, so I don't find it accurate. But on a forward basis, I would find it accurate. And a market cap of $50.8 billion. Now, that is one thing we have to consider. The company this year will revenue right around $5 billion, a little bit over $5 billion, I guess I should say. Probably like $5.2, $5.3 billion on the full year. Potentially even more, honestly. I can't lie to you. It could be a $5.5 billion year. So we're trading at a market cap. This price to sales on a forward basis is close to 10, which is pretty expensive right now in this market. I won't lie to you. But we're talking about revenue growth 20+%. We're talking about consistent growth everywhere. I like to see it in the recurring revenue growing massively. I like this stock at these levels. I really freaking do. Especially if shareholders approve this stock split. I like this stock a whole lot when you're looking at a 3-year stack. 3-year basis, this stock makes me go bananas. So I'm buying Shopify stock right now, folks. That's it, baby. Let's go.